For an individual investor, when they are about to invest, there are three important things that are important checklist items that they should look at. The number one reason why investors lose money in investments is because of leverage. So the company has too much debt, or the investors themselves are using debt to buy stock. Okay. So the most important thing when you're trying to make an investment is try to make investments in companies that have no leverage, zero leverage. And also do not yourself borrow any money to buy stocks. So are you familiar with a company called IKEA?
Of course.
All right. The founder of IKEA, who passed away a few years back, IKEA is a private company. Never went public, it's privately held. In his whole life of building IKEA, he ran IKEA for more than 70 years. He did not borrow even 1 Korean won or even €1. He did not want to borrow money at all. And IKEA never went public to raise money in the public markets either. Every single store was opened out of the retained earnings from the previous stores. And the reason he did that is for Ingmar, who was the founder, he wanted IKEA to last for 500 years. He wanted it to last for 1,000 years. And so he built the company with principles which will allow it to last for 1,000 years. And one of those principles was we are never going to owe anyone any money, because if we don't owe anyone any money, no one can come and stop us from playing our game. It's a very important thing for investors to not borrow money and not invest in companies. So the best companies in the world do not need debt to grow. They can grow without debt because their business is so good. Okay. The second reason why investments don't do well is investors misunderstand the competitive advantage or the moat of the company, what Buffett calls the moat. What is the competitive advantage of the company? Now, for a long time, the memory business was a useless business. There used to be 20 different memory companies. They were fighting each other and cutting the price and trying to get higher capacity. And in the end, no one would make any money. And eventually they went out of business, or they got bought out, and we end up with three memory companies: Samsung, SK Hynix, and Micron. And it went from not a good business to a very good business. And the moat became much better because now they have all the patents. And because the density of the chips is so high, it's very difficult for a new entrant to come in. The processes are so complicated. Opening a new fab is so complicated. So the second is we want a very strong moat. Try to understand the durability of the business and the durability of the moat of the business. So no leverage, high durability. And the third most important thing is the quality and ethics of the managers and the owners of the business.
So governance in one word?
The governance, yeah. The governance and what is the quality of the people who are running the business. Do they care about the shareholders? Do they care about the employees? Do they care about the customers? Or do they care about becoming wealthy themselves? It's okay for them to like the money, but they cannot love the money. They have to love other things. They cannot love the money.
Right. So it's more about value than profit, right?
Do they love the money or do they love the business?
Oh, okay. That's a good question to ask.
Yeah. If an investor, forget the 213 questions. If the investor just focused on these three main issues, no leverage, quality of moat, quality of the people. That's it. That will save you a lot of trouble. For more than 99% of investors, they should just buy the index.
Why is that?
Let's say an investor wants to buy SK Hynix, for example. Okay, they say, I don't want to buy index fund. I understand semiconductors. I understand AI. I think this company will do well, right? The question I would ask them is, let's say the market cap of SK Hynix, I haven't followed it lately, but let's say it's $500 billion, for example. Okay, what I would ask them is, what is going to be the cash flow that SK Hynix will generate 10 years from now, 15 years from now, 20 years from now? And how does that compare to the 500 billion? So currently, SK Hynix may be making $50 billion a year, for example. What are they going to be making 5 years from now? What are they going to be making 10 years from now? And if an investor cannot answer those questions with a high degree of certainty, they should not buy the stock. Okay. Now, when you ask that question for some businesses, the answer can be very obvious. So one should buy a business when the answer to these questions is very obvious and there's no difficulty giving that answer.
Right.
Okay. So for example, let's say there is a power company in Korea, okay, supplying power to the homes of millions of customers. And let's say that power company makes $100 million a year in earnings. Okay. Now, people cannot change their power company every year. Okay. It's a regulated business. Usually you only have one company that provides you power and so on. And the regulator allows the power company to make a certain return and charge a certain price and all of that. So it's a very well understood, well regulated business. Okay. Let's say the power company is making 100 million a year and you can buy the whole company for 300 million. Okay. Which means that if you hold that company for 3 years and they are issuing dividends of 100% of their earnings, you get all your money back, right? In 3 years, you get all your money back. You still own the power company and it's going to keep giving you dividends for 50 more years.
Great.
Maybe 100 more years. So that has become a no-brainer risk-free investment.
Right.
Okay. Those are the only investments we are interested in. Risk-free. So usually the risk-free investments are in sectors that are hated and unloved.
Hated and unloved.
Hated and unloved. If something is loved, please don't buy it. And so what we are looking for in investing, we are looking for anomalies. We're looking for things,
right.
Anomalies. We're looking for things that don't make sense. A power company should not be available for 3 times earnings. But in Korea, in the past, if you go back and look, there were many power companies available for less than 5 times earnings. Some even at 3 times earnings.
Right.
Because people don't care about power company. Too boring.